So on to the fun stuff we move. We have in front of us the chart for one of the biggest Canadian banks, the Bank of Nova Scotia. And what we see here is a price chart in the candlestick form. But we also have two other lines on the screen. We have a blue line, which represents the 20-day moving average, and the yellow line, which represents a 50-day moving average. Now there is a wealth of information that can be drawn from this chart. So the first thing that you should notice is that SMA, which is the legend on the top left, stands for simple moving average. That's what we're going to be concentrating on today. So you'll notice that the blue 20-day average, because of its shorter time frame, tracks the price much more closely than the 50-day moving average, which is the yellow line, which is clearly more smoothed out because it contains more prices, obviously. So that's the first thing to notice. The second thing is concentrating on the red arrows on the screen. You'll notice that when the 20-day moving average crosses below the yellow line, the 50-day moving average, the price of the stock typically goes down. In other words, it's time to sell. So that happens once in June on the left of the chart, and it also happens in about April on the right of the chart, where the red arrow is. You see that the 20-day crosses below the 50-day. Conversely, if we look at the green arrows, those are buy signals. Those are times when the 20-day moves above the 50-day moving average. So that happens once in August, and it happens again in the middle of, let's call it December. So again, the reason I've chosen this chart is because it clearly exemplifies all of these areas very clearly. It's much more easier to understand. Okay? And finally, I want you to see inside the orange dotted circle that the price goes up and down tremendously, but really doesn't go up or down. It just moves sideways, but trades within a channel. That's why you can't just trade on moving averages, because you can get whipsawed. And that's also why you want to use a short, medium, and long-term trend altogether, so you can get a full and entire picture. We still are using the Bank of Nova Scotia example. It's still the same chart as before, but we have a little bit of different notes that have been imposed upon the screen. So this time what we have is a 50-day moving average, which is kind of a medium-term moving average, and we have a 200-day moving average, which is a very long-term outlook. And what I would like to impress upon you is that many traders will use a 20 and 50-day very often to come to a more short-term trend if it's a good time to buy or sell the stock. But when prices break resistance on choppiness, as you can see on the left part of the screen, that moving average is broken many, many times. They often use the 200-day moving average as a support mechanism, which is clearly outlined by the orange circle there, this orange line, I beg your pardon. That's a support level, and you can see it bounces off support 3 times, which is an extremely bullish sign, and the price continues upward from there, from 50 all the way up to about $60, so very nice and tidy gain. Now, if your head has just exploded, don't worry, we're going to put it all back together, because all that I have done here is combine the first two charts. In other words, this is a catch-all, here's how it works way to look at the times that are excellent buying opportunities. And this captures everything. So we have our 20-day moving average in blue, our 50-day moving average in yellow, and our 200-day moving average in purple, which you should be familiar with from the 2 previous slides. So if we look on the left side of the screen, we see that choppiness in the price. It's just moving up and below the 20 and 50-day moving average. But notice how it bounces off of the 200-day. It's a very, very strong support level. And if you also look correctly at the green arrow, the closest to the left of the screen, that point where the 20-day crosses the 50-day, which is a strong bullish signal. And of course, you can see the price all of a sudden moves from 50 and then comes out at around and peaks out around 55, which then dips below briefly, and then it's another buying opportunity at just above 50 or $54, which is where the other green arrow is. And you can see clearly in this chart how the 200 days of support, why the crossover of the 20 over the 50 day is a good time to consider buying a stock or looking at a long-term trend, and how the price is traded far above the 200-day moving average. So all in all, you should be able to clearly see that these are excellent buying opportunities and how to use the moving averages as support and confirmation levels. Now that we have touched upon kind of the meat and potatoes of the presentation using moving averages and support levels and crossovers, I just want to touch upon the area of simple moving average versus exponential moving average. So here on the screen again, we're using our example of the day, Bank of Nova Scotia, which trades on the TSX, which is the Toronto Stock Exchange. And here we have the exponential 20-day, 50-day, and 200-day moving average. So at first glance, it doesn't appear that there is much difference than the simple moving average. And if you've come to that conclusion, you are correct. Over this amount of time, which is 1 year, there isn't a stark amount of difference in the moving averages, except that the lines will probably be just a little closer together, and the 200-day tracks the price just a little closer. So in other words, there's not a huge difference over the long period of time. However, you should be able to note that on the left side where there's all that choppiness in the price, that the 20-day moving average is pretty erratic and squiggly, much more so than the simple moving average. On to our final chart we move. This is a comparison chart. So what we have are a 50-day exponential moving average, which is in blue, and a 50-day simple moving average, which is in yellow. So as you can see, the differences from the beginning of the year to the end of the year is not very much. However, if we look at this chart in chunks, we can easily note that the exponential moving average has a lot more movement in it, of course, corresponding much closer to the price. So again, exponential moving average is much more useful when considering short and medium term trades, whereas the simple moving average is much more useful when looking over a slightly longer term. But as you can see, they're very closely knitted over a long term, and very more erratic in the short term, especially in swing trading, which is on the left.